Good morning, traders, and happy Father's Day to all the fathers out there. I hope you had a great weekend. And we are Monday, the, what is it, 17th of June, and we start the new work week in the markets. So let's have a look without any delay at what has been happening and what is going to happen this week. So I'm going to try to do it in a chronological order. On Friday, we had those export-import prices coming in from the US, like a little bit lower, both of them didn't change too much to the picture at the time, but then we had the Michigan out as well, and that kind of set a little bit of the Friday top in on the market. We saw the expectations here, the inflation expectations, tick up again, at least coming higher than expected. But the headline indices were pretty much lower. It is a system of communicating vases, this one. When the one goes down, it's usually due to the other one going up. This is mainly driven by energy, gas prices, but they did not really have too much of an impact on the dollar then, especially not while inflation was sticky, and that is something that I've been talking about already. I think it's not so much about the stickiness of inflation or some of the reasons why, but I think those indices here are starting to get important as well. Then we had a few speakers out later in the day. First of all, in between here, we had Mester still erring on the cautious side, but a little line that perhaps caused a little squaring up of the books, let's say, of long dollars into the weekend, saying that they also should not be waiting for too long to start cutting rates. After that, we had Kashkari out. He's still on the higher for longer, waiting for longer side. So that hasn't changed too much from his side. And later in the evening on Friday, or evening for us at least, we had Goolsby out as well, saying that the Fed has a 2% inflation goal, must keep that promise. He says we are going to get there, but he's fine to have a discussion when getting to, or if they get to 2%, when it will be time on changing perhaps the target, but not until they reach 2%. He also said that they can continue, that they can start, to cut rates if they get more months like they just saw on inflation. He did say that the manufacturing and the agriculture feels closer to the edge of a downturn. So still walking all sides of the aisle. It's a bit like all the central bankers right now. They are not data dependent anymore, but super data dependent. I think the Fed is kind of walking on a little bit of a smaller ridge right now. I think if we do see some acceleration to the downside in stuff like employment, which we have seen, despite that bigger NFP, the rest of the employment market is showing a little more signs of cooling down. So I wouldn't completely close September as a possibility for the first Fed cut, just on the basis that things are starting to show a bit of a slowdown. All right. What else has happened? So over the weekend, just a quickie on the South African elections, they seem to have found their coalition. Zuma, first of all, threatened to boycott everything, but then after a while, did take up the positions that they gained in the parliament. Things are cooling down a little bit, and as a matter of fact, this morning I will have a look at that. The South African rand is still trading pretty positive, coming out of those elections and that first weekend of parliamentary sessions over in South Africa. So for the time being, we are still trading. The hope that things in South Africa will be either looking a bit brighter or at least not getting worse for the time being. We also then moving over to some other speakers we had on Friday as well. The ECB, some ECB officials rumored saying that they see no cause of alarm yet over the France's political situation, no spillover effects yet of the market turmoil, although we saw those French spreads over Germany widen quite a bit. They actually are coming down a bit this morning, and we see the immediate effect of it on the rates and on the euro this morning. We're seeing the euro doing a little bit better. I'll come back to those spreads a bit later as well. So we staying with the ECB, okay, we had just Lane out, he as well saying that they still need more data to make a decision. He also said that it's very important the ECB makes clear they will not tolerate unwarranted or disorderly market dynamics. So that is a bit of the hint perhaps at the French situation that they are keeping an eye on it. But on the other side, he says they still need to see domestic services inflation momentum to come down. They keep their goal to hit the 2% in the medium term. And he says the initial phase of rate cuts will see the level remain restrictive. That is in line with what other CBOs have been telling us of late. So they're also data dependent. It did say that July may be live, but then it did also say that they will need more data to make up their minds. So that is still the global line of all the central banks that we have right now. We are data dependent, and if the data tell us that they will cut probably and change their mind. All right. Then moving over to China. So we had a slew of Chinese data out overnight, mixed picture. They also kept their MLF rate unchanged. There are voices in the market calling for rate cuts out of China, but for the time being, they are still preferring to keep stuff unchanged, injecting some liquidity from time to time, but without really moving the interest rates right now. We have seen the building market is still not there, so the CNH remains a bit offered, I'd say, still right now. So the market is still not on board with the Chinese revival, although some of the officials, like Xi, for instance, trying to influence EU, putting a lot of responsibility of troubles or geopolitics and trade issues on the back of the Americans, of course. And we also have Li Qiang right now in Australia trying to mend some of the problems that they have there on trade issues between Australia and China. But the Australian Prime Minister has already said that it won't be a very easy mend over there. What else have we got overnight? I think that is it for China. There wasn't really an awful lot of market moving going on overnight, but a few interesting speakers then. We had on the Bank of Japan side, a former official was saying that the Bank of Japan may be looking to cut as much as 2 trillion yen of monthly JGB buying. That will depend, of course, on the meetings that they have with the market participants. We know from last Friday that the Bank of Japan will hold meetings with the market participants. Let's hope that we get some information between now and the next Bank of Japan meeting end of July. I trust we will get news or headlines on coming out of those meetings. I guess they are going to judge by how much the market would feel comfortable that they can taper their QE right now, and see if some of those whales are interested to fill the void that those less JGB buying will leave. We know that there's about 6 trillion yen per month redemptions in the market. So reducing it by another 2 trillion would leave an already quite a substantial gap then between what the Bank of Japan will do and what the redemptions will be. But we have already heard, as I said, that people like JPIF, the big insurers, won't be waiting for too many rate hikes to start buying JGBs again. So that's going to be an interesting discussion. Ueda was on as well. Usual lines really, saying that service prices are rising gradually. Price rises do reflect the higher wages, but then at the same time, Kishida said that they share the view that consumption lacks the strength as wage growth is fading to catch up completely with inflation. So that's a bit of a double-edged sword there, a bit of a split tongue comments. And Kishida also said that and we know that from the start, I've been talking about that regularly, that they have a very close cooperation between the government and the Bank of Japan. So that seems to have put the yen a little bit back on the back foot, not knowing where we stand right now between the government, the Bank of Japan, the plans for the QE tapering, and as a matter of fact, both of the low yielders are a little bit on the defensive right now, but especially the yen. We know that those JGB yields are not yet holding the highs, not yet pushing through to fresh highs either. So that, for as long as we wait on concrete results from those meetings that the Bank of Japan will have with the market participants, I still think that there's a bit of a risk of well, I mean, it's too expensive to stay long yen for longer. So I think we are going. I don't expect yen to trade fresh lows. That is not my expectation right now. But I do think we are going to be more in a rangy sideways pattern, which could be 100 or 200 points, even because the yen tends to be a bit volatile. But I don't think we are going to really gain fresh ground on prior ranges, you know. What else? Bit of geopolitics. Politics. We heard from the Russians that they want to go to do peace talks, but of course those conditions for Ukraine, backed by other Western officials, seem unacceptable. But the Putin spokesman came out a little while ago, saying that if the current conditions for peace and resolution are not accepted, that the next set of conditions will be tougher. So we are still not an inch further there on the Ukraine situation, unfortunately. Closer to home, then we had the Swiss economic forecasts coming out this morning. They are important because we will have S&P meeting results come just check. Swiss are meeting on the 20th. So that is going to be, if I run forward a little bit here, we are going to get, actually, they say it here for the 19th, and I have it for the 20th. Why is that? Okay. Okay, 19th or 20th, then I thought it was the 19th as well, but the calendar says 20th. I don't know for you see. No, here we go. It is on the 21st. First, we have the S&P, and it's really a limit border case here for the S&P to move again. In theory, it would be a little fast after their last rate cut, but we know they only meet once a quarter, so they may. Inflation has been a little bit sticky, but then the last numbers came back down. Economic growth, the Swiss government said it comes in well below average, but they did revise it just 0.1% higher for this year. The forecast to 1.2% from 1.1% forecasted priorly. They kept the 2025 unchanged. They did revise the expected CPI for 2024 down to 1.4% from 1.5%. This is well within their range. This is below the 2% as well. Are they going to move? This one is probably going to be one that is really very, very hard to call. Jordan may be tempted to call it just because we have seen a pretty decent recovery of the Swiss franc mainly due to moves elsewhere, mainly due to lower yields elsewhere, mainly due to those European issues that we face on the political side, mainly in France, a little bit in Germany as well, and in Belgium, for instance. I think that has had the most to do with the Swiss recovery. Could they be tempted just to keep the Swiss corporates happy to try and manipulate the Swiss franc? No, did I say manipulate? Oh, come on. To drive or to gently massage the Swiss franc a little bit lower, perhaps. They could be tempted to add a cut to what they already did, but that would really mean the last one for this series, because they're already back at what is it, 1.5% or so, which is already quite low in the global markets sphere, right? So yes, 1.5% they're at. Okay, UK. We of course are in pre-election campaigns, pre-election programs, and we had a bit of comment amongst other things, and I'm going to keep it short, this one. So the UK Shadow Chancellor Reeve said that one of the bits in the Labour program will be to seek improved UK and EU trade terms and relationships. That is something that they are going to try to push for. So this is an interesting one to keep an eye on for when we will go into the elections, amongst all the other things. Okay, calculations have been made that in turn there's going to be a bit more taxation and more tax income between Labour compared to the Conservatives. The Conservatives are still not doing very well in the polls. And as a matter of fact, the sterling is looking a little bit sluggish, and I think it not completely politics, but this is also a week of UK inflation data on Wednesday, and then on Thursday we will have the Bank of England. And there as well, it's pretty uncertain of what's going to happen. Main base case is for the Bank of England to hold the rates still at where they are right now, preparing us for a potential rate cut. But the votes will be very important, of course, because there may be a few members siding more with the cut this time. And I would say there is a fair chance this time that we will see a more dovish Bank of England. So I'm not sure whether that is the early trade of the week, or it is just a bit of euro recovery that we see versus everything. That is very possible too. But it does look like the sterling is losing somewhat of its shine right now. So that is one that, of course, sterling is going to come more and more to the forefront as the week advances. Do I have? Oh, yes. Yes. Next night here, we will have the Australian, the RBA interest rate decision upcoming. They are firmly expected to be on hold. We've heard Bullock say that there was even a hike in the discussions last time, which they did not. I do not think that it deserves a hike, the data that we have seen, but we can also confidently say that what we've seen in the data is not for them to cut right now. So they are going to be on hold, and then it depends on what the statement says, whether she still decides to remain extremely hawkish and keeping that interest rate on the table, or if they judge that now just waiting and the higher for longer case is going to be more the one to focus on than keeping hikes. So that's going to be the little bit of the balance between hawkish and dovish. Between hawkish and dovish, that will be the balance, I think, whether they keep the interest rates firmly on the table or whether they water down this statement a little bit. So that's going to be the mover for the Australian dollar in the immediate. And then tomorrow, of course, we will have another set of CPI. I guess those must be the final ones for May coming in from the European side. For today, what else is there? We do have June New York Empire State Manufacturing Index coming out. It is a volatile number, okay? But it has been showing quite negative readings over the past months. So we are still expecting another negative reading today, minus 12.5. It can be a bit of a surprise index, but another negative data is a bit where Goolsby was talking about, that he sees that manufacturing side, and we have seen those manufacturing data slowing down markedly in the US of late. So that's one to monitor later on. And then we will have another program. It's a bit of a lighter program this month, if I'm correct. So we do have the short end. Oh, we do have a bit of a, we do have a 5-year and a well, that small 20-year as well in the mix this week. So we do have another bit of an issuance program on this week, but we have seen that they have been quite up and down of late, those auctions. So and they did not really provide with a long-term impact on the dollar. It's more like causing blips here and there in the on the rates environment over there. And then we will have 2 speakers. There was only one planned, but I did see elsewhere that Williams is expected. So those are the 2 next ones. We will have another big slew of speakers this week from all central banks. So so those are the next ones. Williams should be one that is people listen to, or at least are interested to know what he's saying. And Harker is probably one of those, if I'm not mistaken, that will have cited to only one cut. So that's going to be interesting to hear what he has been saying. All right, and I think so. We saw the Italian numbers here coming out roughly as expected. The European labor cost index, but it's still a Q1 number, right? And we know that they have been sticky there, but that supports the talk of the ECBers saying that they want to be waiting for more data to come in to make a next decision on all things interest rates, and that supports it. And actually, as a matter of fact, since they came out, we do see the euro keeping, especially on the crosser side, keeping that big tone in. Okay, I think that is where we are. We can look at rates. First of all, if you want to know what's going on with the euro, I'm not saying for the 5 or 10 pips or whatever, but if you want to know the overall sentiment, what is going on in euro, and then I'm specifically talking about euro crosses, perhaps. Look at what's going on here. We had this around the bottom side of where we hit the euro dollar euro crosses, around the bottom of the euro. We did roughly the top in those French-German spread. Okay, so now this spread has been coming down, hovering around a little bit, nowhere near levels where we were before the stress started, but we do have a little bit of less stress, and that is pushing people to manage their positions a little bit. And what's happening then on the euro is exactly reflected on those crosses. So you do the inverse. of what's happening on the spread side, and you see the euro trading the inverse as well, a little bit recovery, and the euro dollar recovery goes paired with the rest of the euro crosses recovery as well. Now, rates interesting is on Friday, and I said like I look at what's happening in those high to mid 106s. Okay, that could be enough for this round. Well, for the time being, it is enough. All right. We stopped on the 78.6, went a little bit below this trend line, which is a bit of a fragile one, on when the spreads moved out to the highest level, French-German spreads. But we are still holding the triangle, okay? The bigger triangle, we are still holding. That is coming in around 106.5. Again, you look at other spreads. Of course, the euro has suffered on the back of what's happening in France. But if you look at it on a global picture, we are not making fresh lows, okay? We are not making fresh, wider spreads. That means the lower it goes here, this is euro versus US. The lower it goes here, the more it should weigh on the euro, of course. But we are not making fresh lows, so that's why I'm saying, like, for the time being, still manage your expectations in whatever you do, because for as long as we are not really breaking the wider patterns, I wouldn't really go ballistic and trying to trade too much of breaks. I think we are still in wider ranges until proven otherwise. All right, just allow me just 1 second to take a sip of water, please. I'll be back. Right, I'm back. So yes, keep your expectations reasonable, right? Yeah, I will, Brian. So this is where the euro point of no return, no, but I think if we break the triangle, there may be more to come, okay? And that confirmation will come if we break below 106. If euro dollar breaks below 106, I think it's bad news, or something bad is happening. It's likely going to be politically driven, so that's a bit of a hard one to trade, but it would be really bad news. First, if we break 106.5, and then if we start to break below 106, that would be really bad news for the euro. Until then, we trade triangles, ranges, okay? And that's still my base case. Sterling. Okay, on Friday, I thought the sterling move may be a little overdone. We did see a break below 126.90. But my opinion was that it was more euro-driven than really dollar-driven or sterling-driven. So I tried to pick up a few, but then this morning, not making any gains beyond this 126.90, 127, the figure. I just let it go. Euro crosses seem to be the flavor of our morning anyway. And for as long as we are below 126.90, 127, the figure, cable may be a little more on the defensive. There's a bit more coming here, 126.5-ish, 45.50, 126.30 is the prior spike here. But for as long as we stay below this 126.90, 127, there is a risk that we are going to have a look at this level here around 126, 125.90. I don't know what's going to happen on the Bank of England. I don't know what's going to happen on that inflation report. But if we get a bit of a weaker reading on the inflation report, and we get a more dovish Bank of England, I wouldn't be surprised if sterling would suffer a bit more. We have seen sterling do much better for a while. Yes, the euro sterling is still under 85, for instance, and yes, the sterling yen is still pretty close to 200, for instance. But I'm starting to think that the more we are now past half June, we are getting closer to those elections. We are having this inflation report. We are having the Bank of England. I'm starting to think that perhaps this relative resilience, this relative outperformance that we have seen in sterling for a while, could be put a little bit in the fridge and at least until Wednesday and Thursday. I'm not going to say that sterling is going to completely underperform, but it looks as if there is perhaps some more dollar strength or so. Sterling may be going a little faster down than for instance, euro dollar may go down. But on a Monday morning, I reckon the most what we are trading here right now is euro sterling. And well, let me stay on the daily first, okay? Because there is a bit of we are in an activity zone here, right? The activity zone is between 83.90 and 84.20. We have seen spike lows, spike lows, spike lows, and bounce. Look at what we did here. Test of the 84, and we are trying to bounce a bit. Generally speaking, this is still looking heavy for as long as we are below 84.90, 85, the figure. It is technically speaking still heavy, but again, this is not one where I'm going to chase this lower. And I would not rule out that even though I never look at spreads, but I wouldn't rule out that we are going to have a look back up at that 85 level, especially if the market thinks that the European situation is perhaps not getting worse right now, and we are going to put it a little bit on pause until we see clearer in French polls, for instance. We see clearer in what's happening in Germany, because we know that they need extra funding in Germany, and that the coalition is looking a bit wobbly over there as well. So we are not only talking France here, but France is of course the main focus that we focus right now. But I wouldn't rule it out if as I say, this sterling loses a bit more of its shine to get a retest back up to closer to 85. And then we will see what happens on the inflation and on the Bank of England numbers. I've been quite for a long time. I've been trading the sterling as a bit of an outperformer versus stuff like euro and other things. I'm going, let's say, neutral towards. I'm not completely changing my view yet, but I think it's a little more risky this week to be long sterling. So I'd rather perhaps, if I see this low 84 again or high 83s before anything else happens, I may actually be tempted to catch a little knife. It's gone there. It's now trading 84 and a halves. Yeah, I think it's really one. Sterling is in an important week, really, and it could, if things align, as I said, like the weaker inflation or a dovish Bank of England, we could all of a sudden be looking at a bit of a weaker sterling. That's how we are. That's how I am looking at the sterling right now. Yen, still no change, right? We had the up and down swings after the Bank of Japan, based on global yields going down everywhere. But now it's already coming back. And again, I've been hammering on this for such a long time, and it is still I mean, tough to be long yen for longer. Every day you're long yen, you're paying a little bit away. Of course, if you get a 100 points move, that is going to, hey Paul, hi Marcus, that's going to cover all of your funding and stuff. But if there's nothing, or if there's not a lot happening, and that is how the market trades. I'm not saying you have to do it, or you have to go, or you have to sell yen, or you have to do anything specific or whatever. I'm just noting, and I'm just saying that the longer you're long yen, the more you pay away, and the market is still having this kind of attitude as well right now. It can change, and it can change very, very rapidly if we get like concrete numbers on how much the Bank of Japan will reduce their JGB buying. If we get hints that the Japanese whales insurers will be waiting for much longer to step into the JGB market until yields rates really rise in Japan, the yen could strengthen. Yes, but if you look at how this is trading, the market is still not completely on board with it. Okay, we've had big rounds of getting out of carry trades. Um, and yet, look, we are still in the 157s on the dollar yen, okay? And that is because the JGB yields are also not really telling us that it's ready for the next leg higher. And in the meantime, we see a bit of stabilizing on the rest of the yields, as you can see here. We're still in that 420s. Yes, we are on the US 10s below the 435, 440, but it's not really falling out of bed either. We will see on the data coming out this week, because we will have data coming out this week as well on the dollar to see if it warrants a lower dollar, in which case dollar yen could of course come down. But in the meantime, I'd say be a bit careful for those who want to counter trade everything. If we get back above 157, 75, 85, 158, the figure, it could actually push through a little bit. Also, let me have a quick look at what's happening in the equity markets. Relatively stable right now. Okay. Yeah, I mean, if we get a lower equity markets, then perhaps the yen is going to get a bit stronger. But for now, I'm still not in the camp to be long yen for longer, and it's looking pretty much the same on most of those yen pairs. You know, if you look at Kiwi yen, I showed you we didn't even go and test the support of the broken channel here, and we are already back to higher levels here. That is one of them. So the other one, and this is now going to be again an interesting one to watch over the RBA. We're a while away, okay? But look at the number of tops that we have done in this Aussie yen, and that's all 104.90, 105, okay? 104.85, 105. 105 is really your level. If that breaks, I think there may be model funds, speculators, hedge funds. If you start to break this, I think they may, and that may happen over if the RBA is extremely hawkish tonight, right, or early morning. That may happen. Okay, I'm not ruling it out. We are a while away. I mean, we are nearly 1% away, but in the end, things can sometimes go further. If in turn we get a bit of a dovish RBA, as it's been kept so often. If you start to get below, and let me add a bit of a level here. I'd say 103.65 and then low 103s, okay? If you start to get below 103s, tackling these levels here, then there is something bigger going on in commodity yen, for instance. And I guess the Kiwi yen will follow suit then as well. But for as long as we're above here, above those levels, I'm not going to rule out, a retest at least of those highs here. Okay. Anything else you guys want to look at? Because it's early week and things are relatively quiet. I'm going to keep an eye on this one. This is the S&P, and I said to last Friday we were talking about this blackout period for a good part of the companies. There's a blackout period starting for the buyback, so there should be less buybacks at play in the US equity market. So it's going to be an interesting watch what the US market will do with the S&P. Still the same levels at play, right? 53.80, 53.70 on the downside, all right? And then those little highs here, we're really not far. 54, 40, 45. If those go again and hold, those still looks like steps to wanting to go higher. But we never know what happens after or when these blackout periods start, okay? Next zone, 5,500 if it pushes through. And if that would go, then I don't have much before 56s. I hear a lot of people talking about 5,600 in the S&P. We are also data dependent, and for 1 or 2 sessions, I would say like it's I don't know what's going to happen due to this thing about blackout. We could be a little bit seeing a little bit of a setback. I wouldn't really rule it out, but we know how the animal spirits can play as well, and people just continue to buy. Okay, dollar mix, yes, the dollar mix. So political situation hasn't changed, Matthew, right? Oh, and I need to watch the I need to show you dollar rand as well. Political situation hasn't watched 1850. We're turning around. I think the mix should remain on its toes. Okay, but again, here on the contrary to what's happening in yen, for instance, it is still an 11% currency, right? And for as long as they don't really push forward with exactly the reforms, and we don't know exactly what is going to happen there, I can see a bit of sideways going on, and I would not even be surprised, Matthew, if at one stage we crack this 1835 again, and we're going to have like looking a little bit lower to then find again support. Okay, so 1835, 1820, 18. All right, 18 the figure. Those are your levels on the downside. I think this is a bit too close a trend line for comfort. I'm not even going to remove it. This is not worth it. But 1835, 1820, 1800, okay, on the downside. If we start to push back again, back through this little 1865, 70 zone, then I think we're going to go back into the 90s. Ultimately, I'm not going to make a big bet on this one. I think we can see 19. I think we can see 1920, but the long-lasting effect of weakness in the mix will be driven by the magnitude of the reforms that we are going to get from Mexico. Okay, it can come at any time. We know they want to do it, AMLO and Sheinbaum, so it is going to come. But are we going to get first of all a bigger retracement? It's all possible. I really don't know, to be honest, on that one. Dollar rand is trading the positivity, the short term. I would say the short term positivity on what's happening in Parliament. We are coming down on the dollar rand. I've got like really tiny that I bought here. I'm quite willing to keep that running for now, but and I will be very interested to see what's happening in the 1810 down to 18, the figure level. If we get down there, it is currently trading at 1823.24, so around the 78.6. Any level could be good enough to stop it, but I don't know for how long this positivity can last. We know that sometimes this stuff can last a little bit longer than we may expect. So yeah, I'd say keep an eye on what's happening in the 18 low 18s if we get there. And if we get there and we would see a break of 18, there could be a quick run down to 1770s. But here as well, there's a bigger triangle at play that comes in around 1808. Give and take a few clever stop runners, I guess, and we could see it back down to 18, but I think around 18. I still think that the positivity is going to be kind of temporary, but of course we can be wrong. So I'm going to monitor the 18 with very small positions, not risking much on this one at all. Okay, so I'm not in a very big play to risk a lot of my portfolio. And Eid Mubarak, Ali, as well. Yep. We've seen support in the Euro Swiss creeping in. We highlighted this level, and it is also where are we? Is it? No. On the Euro Swiss, we held the support that we started to build here. It's still a bit of a fragile trend line, but around in the low 95s. That was the next level that we were looking at in our room. It's also the 61.8 of the 2024 move. So this is where we are starting to hold, and this is pretty interesting. And we're seeing similar kind of patterns on all things Swiss. We know that we have S&B this week. So be careful what you do on the Swiss franc. It may be decided on what Jordan and his crew decide to do on Thursday. Yep, Thursday. And what happens on the European political scene and on the European spreads. Okay, so but 95.10 around, it's been our low. This is an important next level to watch, okay, for the Euro Swiss to hold. And on the dollar Swiss, we have been testing the level that I spoke about earlier here around the 88.80s. Remember, it was a big level on the way up. We've had a first test, we had a second test, we came close again on Friday, but we didn't break. 88.80, 88.90 is your level on the dollar Swiss. Obviously, we have to break back above 90 to start going again, but they are all interesting holds. And again, I bring you back completely to the early part of the show. Don't, until stuff breaks, don't go look too much for the breaks, because if you look at the FX options market, they are still not in the mood to go for very, very high or for alarming levels on the FX volatility. Okay, so still keep your expectations in check, and you should be all right if you trade within the ranges. Take some profits off when you see the edges of the ranges. If you try to build a position, know where your levels are. Don't be afraid if you're wrong to take your stops. Your account will thank you for it. And if it breaks and you're in a good position, if you've taken some off, you will still ride a part and you can still re-enter. So that is still always something that you need to keep in mind. When the levels don't break, don't go and fight them, okay? And that, friends, is it for the start of this week. Thank you very much for being with me while Ryan was off on his couple of days holiday. He will be back tomorrow. Until then, trade safely, and we see each other tomorrow.